Today I want to talk about the best steps you can take to prepare for a recession. And you don't even have to believe that a market crash is going to happen in 2021 to benefit from some of these ideas I'm going to share. At the end of the day, we're talking about practical steps to navigate risk, how to make your investment portfolio a little bit more defensive, or from a personal finance perspective, what are steps you can take to prepare for a recession. And I'm not going to push anything that is dependent on the market crashing in 2021. I'm not going to necessarily say you should have an all-in bet that the Dow is going to crash by 50% next year. At the end of the day, I'm of the belief that I should be providing information and ideas for you to think about, and you should be the one to determine whether or not something's going to happen and what steps you need to take. And I did a whole separate video on a 2021 recession, whether that be an economic slowdown, but at the end of the day, nobody can actually predict 100% whether or not a recession is going to happen in 2021. But what is clear is that for 2021, that it has a huge potential, for better or worse, to have a huge economic shift. And to give a little backing or credibility to what I'm saying, I've done some work as a financial analyst, and what's very clear is that a lot of companies going into 2021 is that they're taking a hard look into their budgets in terms of salary and capital investments. A lot of companies right now are taking a hard look at their employees, kind of determining what are the bottom tier employees. That's where they can kind of cut corners and basically cut costs and eliminate those jobs. And companies are even taking a harder look into what investment decisions in terms of machinery and equipment they end up buying. And while it's certainly true it's best practice for a company to evaluate which employees and which machine and equipment is going to have the biggest return on their investment, the reality is most companies, especially during expansionary periods or periods where the economy is booming, they don't actually do this. They end up kind of taking an easier approach as long as the project ends up having some form of return on their investment, especially when it's so cheap to borrow money, then pretty much every project gets approved, or every employee that ends up generating more revenue or fulfills a need versus the amount that the company is spending on them, then it's a justified expense. But with things being inherently more risky in 2021, companies are tightening up their budget, especially in terms of jobs, which is a point I'll come back to in a second. But before I go any further, to keep it a little bit light, here's a joke about recessions. Due to the recession and trying to cut back on energy costs, the light at the end of the tunnel will be turned off. Okay, maybe that joke isn't as uplifting as I thought, but if you appreciate that joke, please hit that like button for me, and maybe I'll send you a mini flashlight so that way you don't have to worry about the light at the end of the tunnel. Now I'm going to start with probably the easiest and most practical steps in terms of preparing for a possible 2021 recession, which is to take a hard look at your resume and update it, try to remember that LinkedIn password, and maybe start paying attention to those 5,000 emails you get from Indeed trying to recruit you for certain jobs. Look, applying for jobs isn't necessarily a fun process, and unfortunately it's not necessarily a quick process either. And with companies tightening up their budget, especially in terms of salaries and paying for employees, that process is only going to take longer and be that much more difficult to get your foot in the door. So taking the time now, especially if you still have a job and you're not necessarily too stressed out about trying to find a new job, then it's best to use that time to update your resume, get a few steps ahead of everybody else, and especially if you have the time to basically create multiple resumes and tailor it for different skill sets. And even if your particular job is truly really not at risk of being laid off anytime soon, the reality is it probably is at risk of not having that big of a raise going into 2021. I mean, at the end of the day, when a company can just send you an email or a tweet saying, "Thank you for being an essential worker," why would they give you a raise? I thought our company had record profits this year. Why don't I get a raise? You really thought we were going to give you those profits? By the way, don't forget your $5 gift card on the way out. Look, even if your company did have record profits for this year, there's no guarantee that that trend is going to continue. In fact, I would even argue some companies such as Home Depot that have seen record profits this year, that trend is unlikely to continue. With more people working from home, people ended up wanting to renovate different parts of their home, and the reality is unless if your significant other is super indecisive, you only have to renovate your bathroom or dining room or whatever it is one time every 10 years or so. So people that would have renovated in 2021 probably pushed up that time frame and ended up renovating in 2020. So the reality is there's going to be less business in 2021. At the end of the day, updating your resume could never hurt you. So that's one of the biggest recommendations I could give on how to prepare for a recession. Now, somewhat related to jobs is what to do with 401ks or any investment portfolio if there is a potential market crash. So I'm a pretty firm believer in long-term investing, especially using indexes versus, it may be more fun to pick Tesla stock and go all in that. But for me, betting my financial security is not necessarily too fun. But I generally recommend two things when it comes to your investment portfolio if there is a market crash in 2021. One being that this is a good opportunity to basically reevaluate or at least understand where your investment portfolio or 401k or retirement plan is at right now. Take a look at how much money you have in different asset classes. For example, how much money do you have on cash? Compare that to how much money you have invested in the stock market. And that's not necessarily to say that you need to take action on that. Maybe you really do have a good plan right now. So like I said before, I'm not necessarily here to convince you one way or another, just here to tell you that you should evaluate your risk level and adjust your portfolio accordingly. So if you really do believe that the Federal Reserve has kept the stock market artificially high and that in 2021 there really is going to be a stock market crash, then you probably want to hold on to more cash now versus having all your money tied up into stocks. Now, my second point when it comes to your investment portfolios, which may seem a little bit contradictory to what I said earlier about, taking a hard look at your investment portfolio, but it's to not necessarily panic sell or make any panic type decisions. Especially when it comes to money, emotions end up getting tied pretty easily to that. I kind of look at it the same way as a teacher asking you on a multiple choice question if you're sure that's the answer you want to go with. Are you sure you really want to go with answer B? Are you really, really sure? Well, at some point, you're going to actually start to doubt yourself and you may change that answer. So when you're taking a look at your investment portfolio, if you have a good sound strategy, then stick to it. Just by evaluating it, don't start to doubt yourself and change and try something new that you've never tried before. 2021 is not the year to do that. Now, another very practical step in terms of personal finance is to build a better emergency fund. So if you don't have any emergency fund at all, probably now is a good time to consider that. But let's just say that in general, you have 3 months saved for your emergency fund. It's probably a good idea to kind of consider bumping that up to either 4 or 5 months, or maybe you have 12 months of emergency fund built up. Maybe perhaps building that up to 13 months or 15 months is ideal. So whatever your normal emergency fund amount is, I definitely would consider building that up a little bit further. The reasoning there is pretty intuitive. If you believe that more risk is going to happen in 2021, then you want to increase that emergency fund to account for that. If you thought that there was going to be less risk and that nothing necessarily is going to happen in 2021, then you could possibly bump that emergency fund a little bit lower. And kind of related, the other recommendation I would have is this is a good opportunity to pay down those high interest debt. In general, I recommend that this is a really good chance to basically take a hard look at your personal finance and kind of clean up your act and all that stuff. But I definitely would emphasize paying off this high interest debt payments, because if right now you can make the bare minimum payments and possibly push it to a little bit extra because you have a job right now, perhaps later on you end up unemployed or maybe you have to take a pay cut, and then it's just that much harder to make any additional payments. Plus, on top of that, the bare minimum payments you have to make are just going to make it that much harder and that much more stressful. So making a budget, sticking to it, cleaning up those bad financial habits is definitely going to be your best bet to prepare for a recession in 2021. Now, in case you need a little bit of extra incentive to build up that emergency fund and increase your savings, one of the things is that you don't necessarily want to lose out on this recession, right? You actually want to come out ahead on this recession. And I think a lot of people like to say is that most fortunes are built during a recession. Regardless if you 100% believe that statement or not, what is definitely obviously true is that during a recession, wealth definitely changes hands at a dramatic rate than ever in any other scenario. So definitely some people will benefit from recession and some people will definitely lose out on recession. So why not be one of those people that's best positioned to benefit from a recession? Whether it be stocks, real estate, or even an entire business, you want to be in a good position to have those funds available to buy up what you consider undervalued assets. And that doesn't necessarily mean you have to have it completely in cash, right? You can have, your money sitting in liquid assets that can quickly convert to cash. So that way you are able to buy additional stocks or real estate or whatever you're most interested in that you believe has the biggest opportunity. But what I would definitely caution people here is that you're never going to truly know when the market will actually bottom out, whether that's real estate or stocks. For example, you can know that, let's say in your typical real estate market, houses go for $200,000 and they've been trending $200,000 above for the past 30 years. But now homes are selling for 125. Well, there's probably a good chance that that asset is undervalued. But the reality is you don't necessarily know if that's the bottom. Maybe the bottom of the market ends up being around $100,000. At the end of the day, I'm not necessarily overly concerned about finding absolutely the best 100% best deal out there and I timed the market perfectly. What I'm more concerned about is just finding a great deal. So the reality is, if you think about the effort and time to predict the market accurately, not only is it extremely unlikely that you're going to be able to do that anyways, but if you think about effort and time in terms of money, then the amount of money you're spending to find the best deal, you're probably just better off finding a pretty good deal and saving on that time and effort. And I should also note here, just because you find something that's undervalued, so once again, you find a house that's worth $125 in a $200,000 market, that doesn't necessarily mean you're going to recoup that money in the short term. It may take a couple of years for that market to actually recover. At the end of the day, when we're talking about an undervalued asset, what we're really talking about is the likelihood for a $125,000 house to jump up to $200,000 house or sales price is at least a lot more likely than, say, that same market, a $200,000 house jumping up to $275,000 when that market has never sold anything above $250,000. So it really has more to do with probability and risk than it does with I'm going to turn a short-term profit. And now probably to get into the last and most critical part of this advice is to not necessarily take one person's opinion, including my own opinion, as law or that it's the final word. What I highly recommend every single person out there do is to basically go out there and formulate your own opinion, or at least have good supporting evidence why you're leaning, one way or another, whether or not there's going to be a recession and the best ways to adjust for that recession. I see all the time people taking advice from somebody who's like a millionaire, he's single, doesn't necessarily have kids or anything, or any kind of dependencies, and yet there's somebody who has a family of 5 or 8, or they have 10 kids, and then yet they're also in debt, and yet they're trying to mimic the same steps that this millionaire is doing. And while there is some truth that you can mimic good behavior, there is something to be said that everybody's kind of in their own financial positions, and so everybody should have their own different financial goals. For example, if you're highly in debt, then it really doesn't make much sense to hold on to cash to buy cheap real estate in a couple of years. That may make more sense for somebody who is out of debt and has their own place right now. So once again, just kind of adjusting for people's different advice and perspectives and making it your own. I think if 2020 has caused anything, it's for people to basically be tired of sensational news or clickbait titles. Just the other day I saw this article about somebody predicting that the Dow Jones is going to hit 40,000, which I just thought was kind of an unreasonable prediction. It's not necessarily too outlandish, but at the end of the day, I had to wonder if this person really believed that or if they were just trying to get eyeballs on their article. Better or worse, we live in a world where the more outlandish a claim is, the more attention it ends up getting, which is exactly why I'm predicting right now that the Dow is going to go from where it's at now all the way to 1,000, and then it's also going to jump all the way back up to 100,000 within the same year. Obviously, I'm joking with that, but in all seriousness, at the end of the day, systematic investing ends up working way better than any kind of trendy type investing. Sticking to a sound strategy, such as investing 10% into the stock market every single quarter or every single month, whatever ends up being your sound strategy that you rely on, I encourage everybody to stick to that same strategy going into 2021. Don't necessarily get too caught up in these sensational headlines and adjust your strategy just because you end up a little bit too emotional. I definitely think things like Tesla, Bitcoin, all these trendy type stocks that people end up kind of caring about just because Robinhood investors care about them are things that I'd probably stay a little bit away from if you're that type of person to be kind of risk adverse and you don't want risk. But if that's your game and you want to be more involved in risk, those are probably the things to look out for then. At the end of the day, I wish everybody the best for 2021. Hopefully nobody listening to this ends up losing their job. But at the end of the day, if you do have questions on how best to prepare for 2021, feel free to comment down below and I'd be more than happy to respond. And as always, if you like personal finance, business, economics, anything revolving around those topics, those are things I really enjoy talking about. Hit that subscribe button. I hope to see you in the next one.